Alright, hello everyone. So I'm just going to do a little review on a couple of markets. It's going to be an accumulation review where I'm going to show how it's done on probably gold, and then I'll take a look at some other markets. And I'll show you how I do it. The first thing is just going from higher to lower time frames, because accumulation occurs as a higher time frame pulls back. Accumulation occurs on the lower time frame. So you just have to look at a higher time frame and see the rally, and then when it pulls back, look at a lower time frame and see if the accumulation is occurring. So the higher time frame, I'm going to use the daily, and for the lower time frame, I'll use the this point and figure with volumes called a tape reading chart. And then in addition to that, I'll go one time frame lower. Why? Because as the daily pulls back, the middle time frame, the middle chart, will show accumulation. And when the middle time frame rallies and pulls back, the lower time frame on the right hand side will show accumulation. So you can see the accumulation occurring on any time frame and a lower time frame, any higher time frame and a lower time frame. You can do that with basically any higher and lower time frame. All right. So first thing is we'll take a look at how this trend. You have multiple higher highs and lows, how it started. This is gold on the daily. So around 1901, how it started, and now it's went up to 1990. So let's just take a look at that. So we see that the market pulled back to 1901. On the left-hand side in the chart, we see the rally down because it was in a downtrend. When it did that, you had a significant amount of volume traded here, a spring, continuing the base, and finally the breakout to a higher high. That's what you want to see in a base, in an accumulation. You want to see a base, you want to see high volumes, possibly a spring, and then a breakout on heavy volume. That right there is, I mean, literally is what you need. I know there's a lot of stuff on the internet that's showing you these crazy bases with phases and all that, but I mean, I'll show you the facts and reality in real markets right here, right now. All right, so this is reality and not anything fictitious. So you see that the market rallied down, and when it hit that low, there was accumulation, and all it is buying a lot. All right, and in order to do that accumulation, it needs to stay within a range. It needs to have a base with high volume prints in it, and then break out with heavy, strong volume making higher highs. That's really what a base is. At least with what I'm going to show again and again, that's what happens. It's just buying low. And buying low is indicated by high volume prints at a low price and at that level, meaning you have X's and O's parallel to each other, side by side, and that's about it. So this here was 1901 accumulation, hit a spring, reversed, and broke out. This was the hard breakout right here, which is on 41,000 and then 55,000. These are the two high prints. And the entire thing is 126,000 contracts here, taking out the base and then making higher highs. After that, it had a hard pullback within the base. As it pulled back within the base, held, and then broke out to the upside, 45 and 37. So basically what happened is You have a base, you have a rally, you have a pullback to test. That's all it is, right? And now, now what we're trying to do is figure out how this thing makes higher highs. So market, breaks here, and then it goes up. So the first thing you want to do is when you see a rally, you're trying to figure out where to buy. Look at where the strong hands are. Now the way you find strong hands, and the CM when Wyckoff spoke about following the footprints of the composite man and all that, the footprint is literally the footprint, meaning it's the volume at price. All right, so the footprint of this composite man is right here. In this rally, in this up wave or this up column or this up bar, the footprint is right here. That's the footprint. So at that point, immediately you want to mark that level, and you want to mark at least the high of the box, because it typically taps the high or goes in, and you just have to be ready for it. So now it's going to pull back. What you want to do is now go to a lower time frame and see what happened. So we see as price goes to that level, it starts some accumulation here, and then does that shakeout and has a V bottom followed by the right hand side. So this is the base, and you'll have that, like sometimes the base is not at a bottom, but you have a V bottom and then it bases up a little bit higher. So this is the base. All right, so it did that, had a high volume, $150,000 contracts. Goes sideways, they're just buying more and absorbing. And then you have really violent breakout right here with 71,000, 52,000, and 62,000. So that in my opinion would be the markup. Okay, so again we have a level, high volume here, taps, and this is the behavior, and it goes up. So now what you want to do is see how it's going to behave on the next pullback. So the next pullback after this up wave, the next footprint is right there. So it pulls back into that 56. We want to see what happens there. This is the ideal one, because as it pulls back, it bases out very clearly. Very, very clearly. I mean, this is as easy as it gets. So it pulls back. It moves sideways, but that sideways is on top of a higher time frame block. You see the white block? That is where the CM is. So it starts accumulating on top of that high volume white box, whatever you want to call it. So that's what it's doing. This is reaccumulation here. And again, if it's just moving sideways, we don't know what is it. We don't know. You don't know. I don't know. No one knows except those who are buying. We only know after the break that this is very likely reaccumulation because of the higher high and break. So now put the order here, comes back, tests, you're in. So you get the reaccumulation entry. And now it's going higher. So now it's going higher. Where is the next footprint? There is none. I mean, that's there, but it's resistance. Why? Because it breaks out on heavy volume, and there's no pullback into there. I mean, it's all on the top. White box, white box, white box, white box. So it's basically distribution. So here we have evidence of distribution. And it's going to pull back, test in it, and reverse. So we can take a look at this. All this distribution, and yeah, reaccumulated here and did all that shaking and dancing. Here again, we have a situation where we have a break and we have a clean print right there, 31. So now we just move that level there. All right. Move the level there. And now pull back up, pull back. You have a base and you have a break, higher high. I don't like this base particularly because there's no high volume prints in it. But I know that, you know, when it goes here, this is where it's supposed to base out and reaccumulate. At least the likelihood is quite high. All right. And when I have these higher high signals, and at least I have a base formation and a break, and that break has a high volume up here, 13 and 20, I would prefer, yes, I would definitely prefer that it has a high volume in the base, but that just didn't happen. So you just have a base and you have a break on top of that footprint, high, you know, white box. So, you know, goes in, tap, break. You gotta look for the entry, catch the entry, and bang, goes up. Now you're over here, and this is a problem because, I mean, if it's you see when you have these white boxes at the top, there's no follow through. That means it is not absorption. It is not breakout volume. It's not absorption. It's selling, and that selling will initiate pullback, like it did here, like it did again here. I mean, it's the same shit you're gonna see, right? So this is too much. At the highs, if you have lines of resistance or lines of high volume, that's distribution. It could be a minor distribution that initiates the pullback within the trend, but it's distribution nonetheless. I mean, that's what it is. Anyone, you know, if you don't agree with that, say, what is this, all this white box and selling up here and then red bars down? There's positions being established, or taking profits, heavy profit taking. You know, so you have white boxes, you have that line, that means it's going to pull back. So if you're trading with trend, you just back off until it's reestablished. It's reestablished here, boom, gives you the test, gives you the accumulation opportunity, and you get it. Here, I'm not messing with it until it reaccumulates. So right now we have no evidence of any reaccumulation occurring. So what are you looking for here on gold? You're looking for this to pull back, to go sideways, and a break, just like what happened here. Take a look at this. This selling, pull back, breakout. Selling, pull back, sideways action we want, and then we want breakout. That means you have a continuation opportunity. You can start looking for reaccumulation attempts and enter them. All right, folks, so that's the study. Now, as you'll see, I'll just do this again on, crude. All right, so this is crude. We have a daily chart. What's the trend? Trend is up. What are we looking for? Accumulation. If the trend is down, what are you looking for? Distribution. Simple as that, right? Because we're trying to get rallies. We're trying to get those rallies. how do you get those rallies? Okay, that's the whole, that's the only way you're going to get high R. Only way. Otherwise, the counter trading and the ranges is a pain in the ass. So, anyway, so we'll take a look at the first pullback and see how it occurred. So market pulls back on the daily. What do you have? You have a base developing. Base and a breakout. So, I mean, I've indicated this many times. This is the way the market moves. It bases and breaks out. It's this accumulation and then markup. That's all it is. The breakout is your markup bar, or that breakout, the first breakout into the markup phase. All right. So, what do you know about this now? You know that as soon as it taps this area, there should be some accumulation. Now, this is pretty deep. The pullback here is much deeper than I would have expected, but sometimes that's what happens. So what we now want to do so I have to mark the level. Mark the level right there. Okay, so a breakout, we mark the level. So we want to see it's literally always at top or in the level. That's where it's at. Okay, so now price is going to pull back. It doesn't accumulate here, it doesn't accumulate here. Now, what is going on here? It's accumulating. How do you know? Sideways basing actions, especially with heavy volume prints. So, I mean, it did some accumulation here. When it breaks, it makes a higher high, you can get in on the pullback. And over here, it gives a very shitty move. But, I mean, what are you going to do? Right? So, it wants to go lower and then reaccumulate or shake out, which is what happened here. This is actually the accumulation. It gave a little move, then they shook out everybody, and then they accumulated sideways. When it goes accumulated sideways and rallies, the pullback is yours. Take the pullback. All right? So where is it going to pull back into? Right into this area. That's exactly where it goes. Tap and go. See? You see, the key here is that, strong hands don't like to lose any money. So they're not going to. All right? But the ability to follow them and identify what they're doing is a little bit, I mean, that's basically where the skill comes. All right, so where am I? We could also take a look at this one here, right? Because you see this is a breakout, this is a test of the breakout. So you would have a level here and a level there. Hands go sideways and breaks. This one's I don't like this one. There's no high volume prints. But where is the one I was looking for? I'll show you. So the level, let's say this broke out, right here. See the breakout, big green. Now put that there. All right. Now, what'll happen here? Never mind. Now, where I'm at. Okay, so breaks out. Now we wait for the pullback. Pulls back on top of the level and break. and break. And finally gives it over here. This one's a little bit challenging because if you don't have these stops in the right place, it would have caught you. But you have to put your stop under the extreme low. And what we see is rally, pull back into the test. And it's a small move, it's not really that big. Never mind, I take that back. It is a big move. It's just a complicated move. Typically, accumulation have in my opinion, are the best setups because you're targeting markup. I mean, what else could be better than that? All right, we're done with this. So where do I want to see this thing next? If this high gets taken, I think it's either this or this. Probably here. Anyway, let me go to the ES. I don't want to waste my time here. All right, so let's take a look at the ES. All right, so first thing is look at the major accumulation that occurred on the daily pullback. So you have a daily over here, boom, boom, right there. I mean, it's clear as day, right there, right? So now what do? You just wait for what? The higher high breakout, boom, right there. Now it's game. I mean, you wait until we get to this level. You'll see what happens. All right, but get rid of all this and show. All right. So the ones you want to take a look at. Market goes, breaks right there. Just draw the level on top of the box. See that this one or that one of them is going to get tested. I'll just take the higher one because I'm already looking for a dip below that. So we will take a look at the dip below the line, the box, and see if there's any accumulation there. So let's take a look. There you go. See the market, it goes up and it pulls back. Now you just wait. Whatever you do, don't do anything like, just hit the long, hit the buy because you think it's breaking out. Some dumb things. So you just look at this coming back into that level, moving sideways, high volume prints. Now just wait for that breakout higher high. That's all you got to do. Bingo, right there. Big thrust, big volume, all of that. That is markup. That means accumulation is DONE. And 1, 2, 3, entry, bingo. Time to get paid. You know? All right, now it pulls back and then continues higher. So now, where's the next levels? Just move this up to the next white box. Right there. Right? Now you see what happened. Price tapped it and went. So this is what happens. So price is going to rally. There's a lot of climactic action here. Even though there's a climax, there's going to be some reaction. Even though there's bull climax here, market's turning, it's going to pull back and it's going to give you something. Watch. Move down. Here a little bit. No. It has to go through the level. This is the level. Market goes, sometimes it doesn't go below, it'll just tap the level as here, like the 10 is tapping the level right there. And then it moves sideways, and bang. And you can take it. And of course, it's only a little move. Why? Because as you know, the market is rotating downwards. So you can't do anything about that. Worst case is either you lose very little or it's a break even. In this case, it would be partial profit, because if you bought it here, you should take some on the way up, at least some of your position. If it pulls back here and then goes up, I mean, this is the small profit. And now it's going to go into that level, so we want to take a look at that level, probably that level. That's the major level right there. There. That is the money level right there. So, all right, that's all. All right, so let me just reiterate. Any market, you can use 3 time frames: a higher, a middle, and a lower. The higher time frame is the overall trend, and that you could just use the daily chart. Some folks want to use the weekly and all that, but and I think that's fine if you're making bigger moves, right? But typically, more than 3 time frames is going to be challenging to coordinate. So 3 is the best. So you have the daily time frame, and then on the middle chart, use the tape reading chart or your volume profiles, or I don't know what else, but the idea here is find areas of heavy volume. Typically, they're the breakouts. So you find a high volume breakout. You might find congestion areas with high volume and then the breakout, right? So now, where the high volumes are, you just put a level there. That's it. Now, you look on the lower time frame. As price goes to that level, is there a base? As it tags the level or goes below it, is it moving sideways? Is there volume in the base? Which means that they're buying price levels and accumulating a position. Do not go for an early entry. Just wait for the breakout higher high. When you have that breakout higher high, you qualify it, see the volume in it, and see its range and total volume. That will tell you that from the base, the breakout, the green bar, is marking up, and it's taken out all the overhead supply above the base. Because that's what it's doing. The high volume is demand overtaking all the supply, because they've taken everything in the base, so now it's time to go higher, right? So after that, all you got to do is get in a pullback. So however you want to, whatever your entry mechanism is, pull back to average, or profile level, even moving at, I don't know, just whatever, or a risk-based entry, doesn't matter. That's the point where the entry opportunity, I would take a look at this, right? It accumulates here on top of the level, and boom, break, right? Right there. So I see the 19. I don't get in immediately because it's not a good pullback. So then it pulls back later and goes right into where? The 108. 108,000 across this biggest line. So tap in and you get a little move, but a move nonetheless. All right, take care, bye.